Today, I'll be breaking down Intel's fundamentals. Intel, once the undisputed titan of the semiconductor industry, has seen better days. Their stock prices took a dive, hitting the mid-$20 before making a comeback to mid-$40. The reason? Intel's been struggling with keeping pace with Moore's Law and creating cutting-edge processors, both in terms of chip design and chip manufacturing. In personal computing, Intel finds itself amid intense competition from AMD. Additionally, there's emerging speculation about Microsoft's potential move to enhance Windows compatibility with ARM processors, an initiative that echoes Apple's strategy and could introduce new challengers to Intel's market segment. And it's not just PCs. In the big server farms, Intel's trying to fend off competitors like AMD and the rise of ARM chips, while also dealing with a shift towards artificial intelligence, a field where Nvidia is dominating with its powerful GPUs and software. Intel's playing catch-up, but Nvidia's still in the lead. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. In the last decade, Intel's financial journey has been marked by notable instability. The company's revenue saw an overall decline of 2.9%. More notably, since 2020, we saw a drastic 31% fall in revenue, which points to the considerable hurdles Intel has encountered. Net income and earnings per share also took a substantial hit, plummeting by 85.9% and 83%, respectively, marking another concerning sign for stakeholders. Compounding these challenges are the free cash flow figures, which alarmingly swung to a negative $17 billion. This discrepancy between cash flow and net income, which traditionally move in tandem, adds to the pressing concerns regarding Intel's financial situation. Shifting now the focus to Intel's profitability metrics. Historically, the company has enjoyed a strong average gross margin of 54.9%, but recent figures indicate a plunge to 40%. The operating margin has narrowed to a razor-thin 0.1%, compared to a robust 21.5% 10-year average, signaling a critical juncture for operational cost management. Free cash flow margin, which prior to 2020 averaged a healthy 19.3%, has dramatically fallen to a negative 31.2%. Scaring. Furthermore, the return on invested capital has sharply fallen from an average of 20% to a mere 0.5%, reflecting a drastic reduction in the company's effectiveness in deploying capital to generate profits. Moving on to the solvency dimension. The quick ratio, while slightly reduced from its 10-year average of 1.41 to 1.15, remains above 1, indicating that Intel is still in a reasonable position to cover its current liabilities. The debt-to-equity ratio has modestly risen from its decade average of 0.39 to 0.45. This figure, despite the increase, is within a range that typically signifies financial stability and a conservative capital structure. Looking at the net debt-to-EBITDA ratio, there's a more pronounced increase to 2.52 from a 10-year average of 0.75. While this jump may seem significant, it is not necessarily alarming but does suggest that Intel's leverage has increased relative to its EBITDA. Lastly, the negative free cash flow has led to a negative debt-to-free cash flow ratio. This metric highlights the current challenge Intel faces in generating cash to service debt, underscoring a potential area for improvement in cash flow management and debt reduction strategies. Now the important fourth dimension, valuation. The enterprise value-to-sales ratio is currently at 3.91x, slightly higher than the 10-year average of 3.30x. The EV-to-EBITDA ratio has jumped from a 10-year average of 10.41x to a current 21.99x. Furthermore, the price-to-earnings (P/E) ratio currently stands at an elevated 111x, far surpassing the 10-year average of 33x. This high ratio is indicative of the market paying a higher price for Intel's earnings, which is in part due to the decreased earnings themselves. Should Intel's earnings rebound to their previous levels, we could expect the P/E ratio to adjust downwards, more in line with historical averages. The fifth and last dimension is the shareholders' return. In order to allocate more capital towards its business transformation, Intel reduced its quarterly dividend, leading to an overall 17.8% decrease in dividends over the past decade. While reinvestment in the company is vital, shareholders typically look for consistent growth in cash flows and, by extension, dividends. The dividend yield has correspondingly declined from a 10-year average of 2.6% to the current 1.7%. While this decrease may concern income-focused investors, it reflects a strategic decision to prioritize business investment. In terms of shares outstanding, Intel has effectively utilized share buybacks to reduce the number of outstanding shares by 16.7% over this period. However, it's noteworthy that Intel halted its stock repurchase program in 2021 and has seen a slight increase in shares outstanding since then. As Intel continues to invest in transformation, it's reasonable to anticipate that further share buybacks may not occur in the near future. Finally, the current negative free cash flows have led to a negative payout ratio. Intel is in a position where it is funding dividends through debt, a practice generally seen as unsustainable. This highlights the urgency for Intel to return to positive free cash flows. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 1.7. Yikes, a terrible rating for Intel. Despite the severity of these financial setbacks, it's important to approach the situation with a measured perspective. While these figures are undoubtedly serious, we must count for the strategic actions and renewed focus on innovation and market adaptation that management has been focusing lately. It's not yet time to count Intel out. Now let's move on to Intel's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Intel's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. For the base case, the fair value of Intel's stock is calculated at $72. This suggests a potential undervaluation of 61.8% compared to the current stock price. In the more optimistic bull case scenario, Intel's stock fair value climbs to $92, indicating a possible undervaluation of 106.6%. Conversely, the bear case suggests a fair value of $54 for Intel's stock, which still is 20.3% above the current market price, again signaling potential undervaluation. Overall, the analysis culminates in a 5D rating for Intel of 1.7, and the weighted average price target of $72 further implies that the stock may currently be undervalued by 62.5%. Putting all together, my final verdict is, not even with a 10-foot pole. Despite the apparent severe undervaluation, Intel is currently undergoing through severe business challenges and increased competition. Intel will need a hoard of cash to turn its business around against key competitors like TSMC, AMD, Nvidia, and ARM chips. While Intel may come up on top again, this will be a very risky trade, and I'd like to see the light at the end of the tunnel before I engage on a trade like this. And I'm not yet seeing the light at the end of the tunnel. Nor I'm sure we'll ever see it again. Your perspective on this is as valuable as any financial analysis. Do you believe Intel has the capacity to navigate through these challenges and reinvent itself successfully? Don't forget to subscribe to my channel and stay tuned for the next analyses.